All right, welcome to this week's briefing on the European auto sector. For months, the name of the game has been defense, right? Battening down the hatches. But now we're seeing a really interesting pivot, a move to what we're calling a selective offensive. Let's break down what that actually means on the ground. So, what is this selective offensive? Well, think of it as a shift away from just cutting projects to stay afloat. Instead, companies are getting aggressive. They're strategically pumping capital into production that can happen right now, making very targeted investments. And, this is the clever part, using that money as a bargaining chip with governments. It's a much more proactive and, frankly, a much more exciting playbook than what we've seen lately. So, what's the first major result of this new strategy? A massive shakeup at the very top of the EV market. A new leader has officially been crowned in Europe's electric vehicle sales race, and it's a big one. So who actually won the EV sales race in Europe for 2025? For a long time, the answer felt like a foregone conclusion, didn't it? But when the final verified data came in, well, it revealed a pretty surprising upset. And there you have it. Volkswagen Group has officially, definitively, overtaken Tesla in European EV sales. This is a landmark moment, folks. We have a new number one in the region's incredibly competitive electric vehicle market. So the big question is, how did VW pull this off? You know, what's fascinating is that it wasn't about some revolutionary software or a next-gen battery. This was a win for classic, old-school automotive scale. They leveraged their multi-brand strategy to perfection, pushing high-volume models like the VW ID.4 and the Skoda Enyaq. And maybe most importantly, their massive dealer network proved that for the average car buyer, a physical place to see, buy, and service a car still beats a tech-first online model. It's a huge validation for the power of legacy manufacturing and distribution. Okay, now let's shift gears and look at the high end of the market, because this whole theme of offense versus defense is playing out perfectly with two German giants taking two very, very different paths. You can see the strategic split right here. On one side, you've got Porsche playing offense. They just kicked off series production of the all-electric Cayenne, pushing a major new EV into the market to keep their sales numbers stable. But then you have Mercedes playing defense. They're focusing on a facelift for the S-Class, really doubling down on protecting their most profitable gasoline and hybrid models. These are two completely different bets on where the luxury market is heading. All right, meanwhile, Stellantis, a company that's been making headlines for its relentless cost-cutting, just made a move that was a real head-turner. It looks a lot like a strategic counterattack. 2 billion euros. That's the number. On February 2nd, the company dropped a bombshell, a massive new investment plan aimed squarely at its manufacturing footprint in Italy. But here's the thing. This Italy plan is so much more than just building cars. It's a masterclass in this selective offensive strategy. First, it's a direct move to handle intense political heat from the Italian government about jobs. Second, they're funneling that cash into key plants like Melfi to launch new hybrid and EV models. And third, the goal is incredibly ambitious, to triple production. They're using a huge investment to get political buy-in and pivot from just cutting costs to driving subsidized growth. It's a really smart play. Okay, let's zoom out from the company's specific news for a moment and look at the bigger picture. We need to talk about the macro environment, the costs, the policies, and the catalysts that are shaping all of these decisions. For a while there, it seemed like government incentives were drying up, but now we're seeing a major policy reversal. Governments are jumping back in. Both Spain and Germany just launched new retroactive EV subsidies. You've got Spain's Plan Auto offering up to 4,500 euros, and Germany rolling out an income-based subsidy up to 6,000 euros. It's a clear signal they're trying to put a floor under the recent sales slump. But while policy might be a tailwind, costs are quickly becoming a major headwind again. The price of lithium carbonate, a key ingredient for batteries, has shot up about 45% from its recent lows. So why should you care about that? Well, it's pretty simple. The party's over. The era of falling battery costs appears to be ending. That destocking phase where car makers were just using up their cheaper, stored materials is finishing. This means we're almost certainly seeing a bottom in costs, which is going to translate directly into renewed pressure on profits for all the car manufacturers in the back half of 2026. So, looking ahead, what's next on our radar? Two key earnings reports are going to give us the next big read on the sector's health. We'll be watching Ferrari's results on February 10th, the first signal on the ultra-luxury market, and then Renault's full-year call on the 19th for a look at the mass market. And all of this leaves us with one final critical question. We are literally watching a clash of business models play out in real time.
VW's victory proves that legacy scale is still a massive advantage, but the relentless push for tech leadership isn't going away. Now, as raw material costs start to climb for everyone, which of these two approaches is actually going to win and define the future of Europe's auto industry? That's the billion or maybe trillion-dollar question.